In just 48 hours, the safe haven became a slaughterhouse. Silver had just touched a historic $120.45 an ounce, the culmination of a nearly 300% rally that made everyone holding it feel like a financial genius. Then, on Friday morning, January 30th, the floor didn't just crack, it vanished. The price action wasn't a staircase down, it was an elevator cable snapping. $1.21, $100, $1.85, finally settling near $78. It wasn't just a dip, it was a 31.4% implosion in a single trading session. This marks the most violent sell-off since the Hunt brothers' corner collapsed in March 1980. For those who don't know, the Hunt brothers famously tried to monopolize the global silver market, driving prices sky high before the bubble burst and crashed the entire industry. Billions in paper wealth were wiped out before New York bankers even finished their lunch. If you're staring at your portfolio wondering what just hit you, or if you're sitting on the sidelines thinking, hey, it's cheap now, I should buy, you need to stop, put the mouse down, because this is the anatomy of the 2026 Silver Massacre, and understanding why it happened is the only thing that will save you from what comes next. Let's be honest about the last few months. You've watched silver outperform the S&P 500, real estate, and crypto. You read the headlines, silver to $200, the industrial supercycle, the dollar is dead. So you did what human beings are wired to do. You bought in. Maybe you bought at $110. Maybe you FOMO'd in at $115 because your neighbor told you it was a sure thing based on US-Iran tensions. You acted on fear of missing out, terrified that the train was leaving the station without you. You went to sleep Thursday night feeling secure, thinking you owned a hard asset that protects you from inflation, and you woke up Friday to a notification that your position had been gutted by over 30%.
This is the classic retail trap. This happens when everyday investors get excited and buy in at the highest prices, just as the big professional money is getting ready to sell and exit. It mirrors the dot-com bubble of 2000 perfectly. Back then, retail investors were buying Cisco and Pets.com because the internet is the future. They were right about the internet, but they were wrong about the valuation. Today, you are right about the industrial demand for silver, but you are wrong about the price. When the taxi driver and the shoeshine boy are giving you stock tips, the top is in. But to understand why the drop was so violent, we have to look at the setup. Context matters. 2025 was a monster year. Silver climbed from $28 to $70, then rocketed past $100 in early 2026. Why? The narrative was intoxicating. Industrial demand is real. We need silver for solar panels, for AI chips, for EVs. We've had 5 consecutive years of supply deficits. The world is literally running out of the stuff above ground. This structural deficit argument is the bedrock of the bull case. Simply put, this means the world is consuming more silver every year than mining companies can actually dig out of the ground. But here is where the investor gets confused with the speculator. In the last 3 months, silver stopped trading based on how many solar panels China was building. It started trading as a high beta gambling chip. In plain English, high beta means it became extremely volatile. When the general market moves a little, silver moves a lot, making it much riskier than normal stocks. A massive amount of speculative capital, money that doesn't care about the metal, just the momentum, flooded into the market. To understand the volatility, you have to understand market depth. Think of the gold market like the Pacific Ocean. If you pour a bucket of water or $1 billion into it, the sea level doesn't change. It absorbs the shock. The silver market? It's a bathtub. When billions of dollars of speculative Wall Street money pours into that bathtub, the water creates a tsunami, pushing prices to $120. But when they pull the plug, the water drains instantly. And on Friday, someone pulled the plug. The trigger wasn't a mine shutting down. It wasn't a change in solar technology. It came from Washington. Friday morning, President Trump announced his nomination for the next Federal Reserve Chair, Kevin Warsh. Now, if you don't follow central banking politics, you might think,
Who cares? It's just a bureaucrat. But the market cares, deeply. Kevin Warsh is what Wall Street calls a hawk. Actually, in this environment, he's viewed as a super hawk. Let me explain that simply. A dove likes low interest rates and printing money to make the economy feel good. This weakens the dollar and boosts assets like silver. A hawk cares about sound money, hates inflation, and is willing to keep interest rates higher for longer to protect the currency. The market expected a moderate choice. They got Warsh. The moment Warsh's name hit the news wires, the US dollar index spiked. It shot up. And commodities work on a seesaw mechanism with the dollar. When the dollar gets stronger, commodities, priced in dollars, get weaker. The dollar jumped on the Warsh pivot, and the precious metals seesaw slammed into the ground with terminal velocity. Gold dropped nearly 9%, which is huge. But silver? Silver dropped over 30%. Why the disparity? Because silver isn't just money, it's an industrial metal. And a hawk Fed chair implies higher rates, which slows down the economy. If the economy slows down, we build fewer factories, fewer electronics, and fewer solar farms. We saw reports from CPM Group's Jeffrey Christian noting a fascinating bearish phenomenon. Refineries weren't busy making coins for buyers. They were backed up with silver that panicked investors were desperately trying to sell back. The supply chain reversed. Instead of metal flowing to the people, metal was flowing back to the refiners. Now, I know what you're thinking, but the deficit, solar panels, the shortage. I need you to listen closely. In a liquidity crisis, fundamentals do not matter. A liquidity crisis is when everyone wants to sell at the exact same time, but there are no buyers with cash on the other side, causing prices to freefall regardless of the asset's true value. Let's look at a case study. 2008. During the Great Financial Crisis, gold and silver initially crashed. Why? Because hedge funds were losing money in stocks and real estate, and they had to sell their winners, gold and silver, to pay for their losers. Silver fell 50% in 2008 before it eventually rallied to new highs years later. But if you were holding with leverage during that drop, you were wiped out. Leverage means you were trading with borrowed money to increase your potential returns, but in a crash, it means you lose more money than you actually own. The market can remain irrational longer than you can remain solvent. Right now, the paper market is dictating the price, not the physical market. The paper market refers to futures contracts and digital promises to buy silver on a screen, rather than the actual physical bars you can hold in your hand. There are hundreds of paper ounces traded for every single physical ounce in a vault. When the paper market panics, the physical shortage is irrelevant in the short term. The price sliced through every support level like a hot knife through butter until it hit the 50-day exponential moving average near $17.81.
That is a technical line on a chart that tracks the average price over the last 50 days, acting as a psychological safety net where traders often step in to buy. That is the only thing that stopped the bleeding. You must understand a crucial reality. The commodity market is not the stock market. The grammar you learned trading tech stocks or ETFs does not apply here. Stocks represent companies with earnings and dividends. Commodities represent raw forces of nature driven by supply, global conflict, and currency wars. If you are a beginner and you don't know the deep mechanics of this market, seeing a price drop and thinking, "It's cheap, I'll buy," is not investing. It is dangerous. If you don't know what you are doing, do not step into this arena right now. If you are going to play in the silver market, you have to accept that it is the devil's metal. It will rip your face off on the way up and stab you in the back on the way down. If you are looking at this 30% drop and thinking it's a discount, just remember, something that drops 30% in a day can drop another 30% tomorrow. We are still up nearly 200% over the last 12 months. There is plenty of room to fall further. Don't be a hero. Let the institutional money step in first. Wait for the demand to show up next week. And for the love of your financial future, do not use leverage on a falling asset. The market will be there tomorrow. Make sure your capital is too.